As we enter the fourth quarter of what has been an extraordinary year, one of the unexpected outcomes is a return of ebullience to the stock market. However, for those looking to get in now, are there still places to find value? We talked to Imran Yassin Md Yusof, Head of Research for MIDF, as to what are the themes that will define the upcoming months, how long the exuberance might last, and what could make it all go disastrously wrong. So Imran, we know that the retailers are back, the punters are back, exuberance is back into the market. And now as we're in the final quarter of the year, staring at the end of what has been a very challenging year. And on MIDF's perspective, what are the themes that you see will carry on in this current quarter and that we'll probably see in the first half of 2021?
Basically, we need to envision how we see the world going to be. So basically, most likely we're still going to get a COVID world. We have the story about the vaccine, but most likely the vaccine will be available to everyone maybe in the second half of next year.
Right.
So with that in mind, healthcare and tech would still be the theme, so to say, for at least until the end of the year. A lot of interest will still come from healthcare. And when we say healthcare, we shouldn't just narrow it down to glove. We're talking about hospital service providers, farmers as well. But then there's also construction as well.
Right.
Very quiet sector. But with budget coming up in November, we might see an interest in construction stocks. And then with government most likely going to announce an expansionary budget to ensure that the momentum of the economy going forward continues. So we might have things like infrastructure projects that have been halted, resuming again. Could be more development expenditure. They just raised the debt to GDP limit as well. So basically government will be able to afford to all these projects.
Is there still value in gloves?
Fundamentally, if we talk about fundamentals, the business case for gloves to continue is still there. It's just that maybe in terms of the boost, nowadays the boost is coming from the ASP, might not be as prevalent going forward. So how we see gloves actually, we are looking at it from being a growth type of stock to potentially being a defensive type of stocks.
Usually the end of the year for markets, October aside, because October, whether you believe in ghosts or not, tends to be a very chaotic month for markets, for historical reasons or whatever. But do you think that this year's fourth quarter will be very different sentiment-wise than it has been last year?
From the retailer point of view, there's two schools of thoughts basically. The key event, I would say, is the loan moratorium.
Yes, that's the end of September, right?
Yes, correct. So if the end of the loan moratorium, either the retailers are going to continue into the market or start getting out of the market. Our view is that we could see volume coming down a little bit. A lot of retail investors might lock in whatever profit that they have gained. They might use this opportunity to restructure their cash flows in a way, with the gains, pay down their borrowings and the like. So the participation into the market from the retailers, we think, is going to come down a little bit. We will not see the same exuberance that we've seen in the month of April, May, June from the retailers.
We were mentioning that this exuberance that we see right now reminds both of us a lot of what we saw in the 90s, whether you were buying stocks or not. But that was then cut short by a shock. In this case, the shock's already happened, but the exuberance followed it. So what is the downside risk you could potentially see? And following on from that, what sectors do you think are still going to have a tough time of it, at least even a year from now?
Basically, the economy itself is one of the downside risks. As we said, COVID-19 remains prevalent. There's always going to be a speed bump or potential speed bump to the economic recovery. And with that presents the downside risk. So for companies that or for sectors that we think is going to recover next year, might have the risk if the economic recovery comes not as what we expected.
Okay.
And then, of course, we have we mentioned about the loan moratorium. For us, that's one of the big downside risks as well, because we might never know what's going to happen, not just in terms of the market, but in terms of liquidity, in terms of participation into the market, but also in terms of NPLs, in terms of provisioning by the banks. Because at the moment, there's no clear indication of how NPL is going, how much more provisioning that banks have to do. So if that were to happen, then you can expect tighter lending practices by the banks.
Which would affect things like property as well.
Correct. And then, and of course, affects loans to companies, to businesses, when they want to borrow so they can do more business. Yeah. And then, of course, another downside risk, and I think this downside risk is not just for our markets, regionally as well, and globally as well, is geopolitics. So you have US and China, where the tensions have been ramped up significantly in the past few months. And one thing we don't expect, this is going to come down next year, no matter who the president wins, or no matter who becomes the president, shall I say.
How do you see KLCI for the end of the year? Positive territory, negative territory?
We believe that it's going to be in negative territory.
Okay.
We believe, as I said, there's a few more downside risks to come. Potential decrease in liquidity that could also affect the market as well. So we expect to have some downward pressure. And of course, although we talk about how global indicators, the global indices have less of a factor nowadays, but we still think that globally, or especially in the US, whatever that's going to happen there is going to have some impact here in terms of sentiment and the like. So we're thinking that it's going to be lower than current levels.